We bet that you are aware of what is currently happening in the banking sector. The truth is, things are not good anymore for our banking sector, and this could be leading us to a recession in the near future if nothing is done about it. Just about 2 weeks ago, Silicon Valley, one of the most important financial intermediaries and one of the most important industrial centers in the world, failed its depositors. It's not new news to you, and if you've been keenly following through our videos and most importantly the video about Silicon Valley Bank, I bet you will understand what we are just about to talk about today. It is within the same weeks that another two banks, Signature and Silvergate, also failed, and have since put a lot of pressure on the other banks too. So what could be making this trend of bank collapse? How will it impact the wider economy? It is quite a very serious problem and a catastrophe that would soon affect our current economy. We ended up naming the current situation in the banking sector as insane and horrible, because it is something that has never happened before. Could we be the first generation to face this scenario? To greater prospects, it is quite understandable if we only see one bank failure. At least that one can be helped anyway. But here, we are talking about 3 major bank failures that happened in quite a very short period of time. Wait, before we dive into what is happening in 2023, let's first clock back to the 19th century and get to see the history of bank failures. Let's begin in 1873. The Jane Coke Company Bank, a great pioneer of new technologies like telegraph messaging to confirm transactions, collapsed after they failed to sell enough railroad bonds quickly enough to cover withdrawals. Now, this is one major collapse during those days. We can term it as a parent collapse because the bank failure triggered other bank runs and set out the panic in 1873, which was called the Great Depression, until 5 decades later. We are speaking of until 1893, when new investments into novel assets like farmland in Argentina and properties in Australia fell dramatically in price, leaving the banks facilitating and encouraging these purchases exposed to bank runs and a deep recession that impacted any sector of the economy. Interestingly, the fallout was so severe in the United States that it led to widespread cultural changes across the country, now referred to as the political realignment. In 1907, there was a loss of esteem period amongst the assertive during the difficult period of economic uncertainty exacerbated by new and unregulated investments, caused by numerous bank runs and a deep drop in financial markets. The biggest Great Depression now took effect in 1929 and was caused by an economic contagion that started with a sharp drop in the stock market, leading to bank runs that rippled through the economy, forcing the industry to grind to a halt. In 1987, savings and loans associations were also another type of bank focusing on consumer savings, and consumer loans experienced runs as their business model came under question during rising interest rates that were needed to combat inflation. The bank failures heightened already difficult economic times. Again in 2008, banks facilitated and encouraged a new type of investment that was put under pressure when the value of those investments fell. The market panic eventually resulted in the single biggest bank failure in US history, and later kicked off the economic recession that we are still facing to date. Now we are in 2023. Is there any possibility that we can be taken back to recession by the ongoing bank closures as we had mentioned in those previous years? We shall see this later in this video. Now, after 3 years of bank unprecedented economic turbulence kicked off by the global pandemic and heightened by trade tensions among various states, developing market debt crises, a war in Europe, and a hangover from the stimulus measures meant to fight these shocks, the economy was in jeopardy. First of all, banks that are using the new technology to encourage and facilitate investments into new and unique assets have already started to fail, as the depositors have become uncertain about their solvency in the current high interest rate and high inflation market. So far, the total value of bank failures is roughly equal to the first year of the GFC, with many economists and commentators predicting that this is just the start of things, and that a lot of other banks from all over the world are also going to be put under this similar pressures in the coming months. Almost following the same suit as the Credit Suisse Bank in the US regional bank, First Republic, last week the bank was on the brink of collapse when it was saved by a group of 11 of the US's biggest banks, who rushed in to restore its confidence. They are reported to have pumped in $30 billion, with JP Morgan Chase, Citigroup, Bank of America, and Wells Fargo each depositing $5 billion of uninsured deposits into the bank. Experts say they did this to prevent a crisis of confidence that would force people to move their money from small and mid-sized banks to larger ones. Fazari also says that risky investment decisions by Silicon Valley Bank and credit crews made them more susceptible to a crisis as interest rates rose sharply and trust wobbled. It seems like SVB and Credit Suisse kind of pushed the envelope here, says Fazari. That interest rate hike that comes to bite them is not a surprise. Silicon Valley Bank's holdings of US Treasury bills ended up being its downfall, as it was forced to sell those holdings at steep losses to meet withdrawals by depositors and rising interest rates. The only question that we need to ask ourselves is, why was it possible to save the Silicon Valley Bank and the two other major banks that closed? We need to realize that most of the 2023 bank failures had a few things in common that made it difficult to save them. For starters, all the banks were involved in providing financial services for niche markets, rather than everyday consumers. Silvergate and Signature did a lot of their business with cryptocurrency exchanges and investors, and Silicon Valley focused on providing services to the types of businesses that made Silicon Valley the global center of innovation. The banks also had very large account sizes. The average bank account size of such banks in the USA was $41,600 as of 2019. Today, it's even slightly higher than that. For example, Silicon Valley had an average account balance of over $1 million, and a lot of their services were not even available to people or companies that had less than that amount. Some of the bank's biggest depositors had tens of millions or even hundreds of millions of dollars in their accounts. Banks like Signature Bank, Silvergate Bank, and other banks that have been shaken by this market panic, like Credit Suisse, also have very large average account sizes because they attract large companies and wealthy people. For the modern person with an account balance of just $5,300, it was easy to settle him or her because this amount can easily be covered. And the worst thing that might happen to him or her is a minor inconvenience. So you can imagine account balances over tens of millions of dollars. This would mean that some few individuals would miss out on the bigger part of their money, since the banks can't cover the whole of it. If you haven't watched our video on Silicon Valley Bank closure, please make sure you watch it so that you have a good understanding of what we are talking about, as we don't want to repeat it here. Meanwhile, the FDIC was formed as a rescue tool for the economic problems caused by bank failures during the Great Depression. According to our former video on SVB closure, you will find that FDIC can only cover up to $250,000 kept with a bank. Anything above that amount is guaranteed to have no cover. And what does this mean to the current state? It means that very soon we might revamp the risk of bank runs, which might result in a recession period. And now, why would a bank crisis make a recession more likely? With inflation stubbornly high, governments around the world have been working to prevent a recession, but it's a hard balance to strike. In the Federal Reserve's case, it has been gradually increasing interest rates, raising the costs of borrowing and discouraging consumer spending. Banks usually have underwriting standards that help to determine whom to lend money to. But if they become concerned about the risks of lending and make it harder for businesses and individuals to borrow money, it could contribute to a recession. Sadly, our banks are seen as less important today than they used to be in recent years, and this therefore would mean a negative impact on the economy. So what should we expect? We should expect a greater inflation crisis, and the only thing you can do as an individual is to prepare for this great recession that is coming. So what do you think should be done to help mitigate this issue? Please remember to leave your thoughts in the comment section below. Therefore, here marks the end of our video today, and we hope you guys enjoyed it and also found it informative. Please don't forget to send us those likes. If you are new to this channel, remember to hit the subscribe button and the notification bell to be notified about any video we will be posting. Thank you guys for watching, and let's meet in the next video. Goodbye.